Hello listeners and welcome to the show. This is Sam Abrika, the CEO of Nova Money, an AI financial planner designed to help you build financial freedom. In this episode, we will learn about a core fundamental quality of all good investors, patience, and about the number one recommended strategy for making long-term investments. Today's guest is Rainey. Will has spent more than 15 years in the asset management industry, where he built investment strategies for pension funds and sovereign funds. Throughout his career, Will has been an actuary, investment consultant, and head of investment. He has managed billions of assets and seen all the ins and outs of investing. And today, he will tell us about the only investment strategy he uses. Hello, Will, and welcome to our podcast.
Thanks, Sam, for having me on. I'm looking forward to it.
Our pleasure. Will, you're passionate about educating kids about finances.
Yes, it's got a company called Blue Tree Savings, which is all focused at actually helping parents teach their kids about money. So I have blogs and courses and in the process of working on a book, all to try and help as many parents as possible teach their kids about the basics of money.
And what do you think is the most important things that kids need to know about money?
So what I've kind of learned from kind of doing this has been that it's not so much about knowledge. Like clearly learning about different money topics is really, really important. So what is debt and how did money exist and what does money do? But it's not so much about the knowledge. It's more about the behaviors and the habits that we create. And actually kids from as young as 7, based on sort of Cambridge studies, form a lot of their money habits by the age of 7, which is when I first heard it kind of blew my mind. But a lot of what we do now with money is based on what we learned from such a young age. So if, for example, if you've got a little bit of money when you were a kid and everyone just said, what are you going to go and spend that on? And then they take you to the shops and let you spend, you form these kind of very strong spending habits. And as you grow up, you keep doing that. And at some point you need to sort of change that and say, well, now I need to save. But as you've kind of developed this really strong habit. So a lot of I sort of talk to parents about is to try and save when kids are young, try and get them to form a habit of saving a little bit of money every time they receive some. So they're forming a savings habit. Not to say save all your money, or it's just save a little bit every time. So then when they become adults, they won't spend all the money that they earn. I think that's just a simple tip, just so powerful. I think it's a game changer if people can learn to save a little bit.
Actually, that's a good point because I remember when I was a kid, the only thing I wanted was to eat chocolate and anything else was just none of my interest.
Yeah.
So how would you motivate a kid like me to save?
So what I do is, I've started this with my kids and started the conversation. So I always got kids to think of money like seeds. And so I say to them, look, every time you get a seed, you can give those seeds away. So that's like spending. But what you want to do is keep a couple of seeds, because kids know what seeds do. If you plant them, they'll grow into a tree. And that's exactly what I want kids to think about with their money. Just say, well, if you keep a few seeds and plant them, in the future, they'll grow. And your money can grow in the same way. And the idea is that once you have a tree, it will produce seeds, which will produce more trees, which produce more seeds. And essentially you get this, in the future, you'll have this nice forest that's just producing seeds for you. And then you have all this freedom because you're going to sleep and getting all these seeds, which is money. And it's just a really powerful kind of way to try and motivate kids to say, well, I want to look after my trees. I want to look after my seeds. I want to grow this kind of financial forest. And especially as kids are learning about the environment and trees, etc. at school, they get this nice affinity between kind of their money and looking after and being protective of it. So that's a really nice thing. And the good thing about that is kids get to learn very quickly to look into the future because most people today spend so much money because they just see money here and now. And it's really hard to look into the future. But if you think of it as money and a seed, you automatically think of a seed growing in the future. So you're kind of putting that nice connection in the future.
That's such a great analogy. And we don't always realize, but we are actually conditioned from our youngest age to see ourselves only as consumers.
Yeah.
So we have money and we have the chocolate, the sweets, And so our only role is to get the money and buy stuff for now.
Yeah, and well, you've also got companies spending millions, collectively billions, to try and program us to do that. And that's all the marketing, all the peer pressure.
Oh, tell me about it.
So we're essentially untrained and going against Goliaths to hold our money versus spending it and generally losing it.
One of the reasons that I wanted chocolate all the time is so I was watching a lot of cartoons on TV, and of course there are always commercials, and in commercials they sell like Kinder Surprise, and look, if you buy this you'll feel so good, you have this toy, and of course in real life the toy is not animated and it's not that fun, it's just like one static little piece of plastic, but they make it sound so exciting. So at the end of the day, it only created these desires of having more and more and more. And well, I didn't really understand when I was 5 years old what was really money and why I needed money to get the things I wanted. But it made me always wanted more.
Yeah, and I think that's still the case today. It's good that some regulations are coming in about food and consumption for young kids. But yeah, no, even for adults today, it's getting probably more and more so, especially with this kind of targeting advertisements that we're getting all over social media. So it's becoming even harder. They know us better than we know ourselves. So
yeah, they definitely do. They have all our data.
Yeah, no, exactly.
I wish there was some advertising about investing. Hey kid, look, if you do this and you're trying to save and invest, you'll have that super great toy by the end of the year.
Yeah, that wouldn't be great. But sadly, there is some advertising, but it's all invest in this and you'll be rich tomorrow, which is clearly not the type of investing that should be targeted at any kind of young adults. I know it's not aimed at kids, but at young adults. And I think that's very scary because it's, again, trying to target our need for instant gratification, both in terms of consumerism, but also in terms of people who are thinking about trying to increase their wealth, but doing it in a kind of short term, probably making more money for the company as rather than the person at the end. But it'd be great if there was some advertising promoting good ways in which people can grow their money over the long term.
So Will, I follow you on LinkedIn and I like what you're doing because it seems like everything you're doing is to train the muscle of the delayed gratification.
Yeah, no, 100%. It's my kind of view is that delayed gratification or patience is like a superpower. It's if you want to be good with money, you have to have patience. And quote from Warren Buffett, one of the wealthiest men in the world, it's kind of the impatient are attracted to money, but money's attracted to the people who are patient. And it's so true. And we live in this world where it's just all instant gratification and people can't delay that. And that's just hurting people so much in terms of taking out debt to feed that instant gratification need. It's quite a scary world.
How would you define patience in your own words?
So I define it as just that process of saying, instead of having something now, let's just wait and have something in the future and know that what we're going to get in the future is going to be better than what we have today. And just being able to say, right, I don't need to have everything here and now. I can have something in the future. And that relates to buying. So I'm going to buy something, or do I need it right now when I can't afford it, or can I wait until I can afford it? But even when we're talking about investing, saying, well, okay, I haven't put my money in and it hasn't gone up 10 times in 2 weeks, therefore it's a bad investment, and pulling it out, saying, well, I'm investing for the long term and being patient and withstanding any kind of noise that goes on with that money in the short term, being patient, knowing over the long term it's going to work out. And so I think that form of patience of just not having everything today is the key.
I think nowadays we hear about the word instant gratification all the times, and I think it's kind of in everybody's mind. However, what is not clear to most people is what's the impact of being driven only by instant gratification versus what's the benefit of the delayed gratification?
Yeah, no, exactly. And I think no one talks about the benefits of delayed gratification unless you go looking for it.
I think that's a problem. We don't talk about it.
No, well, there's no one's got an interest in you having delayed gratification, as in as I said, big companies are spending millions, if not billions collectively to make sure we pass our money from our bank account to their bank account. So that's all being driven. They've got a huge interest in us spending and having instant gratification. No one's really got a huge interest in anyone sort of delaying their gratification, except for the government, theoretically, because they want us to save so we can look after ourselves in retirement, and hence they have some tax benefits, but they're poorly promoted.
I would say government has up to 4 or 5 years gratification horizon, the time to be re-elected.
Yeah, exactly. Yeah,
which is better than next month.
It's true, exactly. But yeah, no, there's no one's really incentivized except for, we essentially have to try and get people to self-motivate themselves to delay their gratification. And that's the hard bit, because on one hand, you've got these companies just doing all they can and know all the tricks to make you do that. And on the other hand, it's kind of, you have to be self-motivated to go and read or find out, or just so happen to have someone in your family, or luckily enough to have parents who are good at delaying their gratification and pass that on to their kids. So it's a losing battle, but hopefully with some of the stuff that I'm doing, that's my prerogative, is to try and motivate parents to really get their kids to do it. And at the same time, it's kind of a Trojan horse to try and also get the parents to start doing more for themselves in terms of building their own wealth, to be good role models for their kids, but also to reassess what they're doing with their money.
I think the worst part of the problem is, although we are entering the instant gratification era, and we all know what are the impacts and how it negatively affects almost all aspects of life, like satisfaction, relationship, money. It's not just about money. It's about freedom and reaching what you really want in life. Nobody's talking about this problem, how it's growing, how it affects almost every single aspect of our life, and what to do about it.
Yeah, that's the hard bit. You have to try and find the players who are willing to spend the money to do that. And as I say, it's just trying to find their motivation to really spend that. And again, there's pretty much only individuals or some companies who are trying to do more of their social well-being type of agendas. So luckily for me, I'm starting to work with some companies, and I go and do workshops for their employees, because they're to try and improve the financial well-being of their employees. So they're starting to be this kind of slow momentum building, with companies doing more and more to help their employees. I think that's great. But companies as a collective, clearly they want our money to spend.
And they want it now.
Exactly. They definitely don't want us to be delaying our gratification, and definitely not saving, because they want that money.
To anyone who has worked in a listed company, they, I think, know what's happening every quarter. So every company are obsessed by the quarter end result, because that's the time they will need to display all their financial reports, the financial performance, the shareholders' information. And at the end of the quarter, they will push like the sales, the marketing. They will try to close all the deals at any cost. The banks will try to make their balance sheet look a bit better, because it's the time of the report. So it's really a quarter rhythm and pace. However, it's not something new. So how did we get there? How did we get in this society where everything is so instant gratification driven?
Well, I'd actually say it's always been there, but it's now getting more and more prevalent, because you do have, now we've got social media where everyone can see all of their peers and all these other people who they think might be their peers showing off all the stuff. So you have that social pressure to spend. And then you get all this cheap credit, so people can get their money, essentially easy money, which has been easier than pretty much any time in the past. And now you can just buy stuff so quickly. You just see something you like. You don't have to go to the shops and find it and go and pay for it. You just essentially see something that someone's wearing, and then 2 clicks later, it's going to turn up at your doorstep tomorrow. And that money's just gone out of your wallet, and you don't even know it, because you don't even see that money being gone. So I think it's actually an increasing problem. And the big difference also from the past is that, say like the baby boomers, so kind of my parents, they didn't have to think about it so much, because there was really good corporate pensions. So there's defined benefit schemes. So they kind of knew that they could kind of spend their money whilst they're working, And then when they retire, they've got this really nice pension. So they didn't have to worry about this delayed gratification because essentially the company were doing it for them because the company were taking money out of their salaries. Whereas today, it's a completely different kettle of fish because if people who have pensions in companies are generally quite small, so when they get to retirement, they're not going to have enough to maintain their same standard of living. So it's not so much that instant gratification has massively changed in the past. It's more, it's going to have much bigger impact on people as the current generations get older and get closer to retirement, and they're going to realize they just don't have enough money for their the same standard of living in retirement. And that's going to be very upsetting for many, many people.
Don't you think also it has to come with all the technologies and the startups that are all trying to remove these little frictions and try to make everything faster and instant?
Yeah, exactly. It's just scary how quickly you can press a couple of buttons on your phone and money's just left. And in some cases, like the scary ones are these kind of in-app purchases where some people, especially kids, they're spending money and they don't even know they're spending money. They're just pressing.
The parents do.
The parents are getting these bills going, what's this? And they just thought it was like in-game play money. They didn't realize it's actual real money. And that's incredibly scary. And that's just technology developing quicker than people can always expect.
So this problem of instant versus delayed gratification is affecting everybody. What made you focus on kids and how did you get started?
So my background is I worked as an investment consultant for a large consultancy firm, both in the UK, and then I moved to Hong Kong to cover Asia. So I was kind of talking to big retirement schemes, insurance companies, and even some governments in Asia. But then about 3 years ago, I was speaking to someone about my daughters who were then sort of 3 and 5 years old. And someone said, enjoy this time with your kids because they only grow up once, which is a hugely obvious statement. But I don't know why, it just had a big, profound impact on me. So I was like, right, I want to spend more time with my kids whilst they're young. So my wife and I put in a sort of a plan together to say, well, we're fortunate enough, we've been saving and investing that money. Let's leave our corporate jobs and spend more time with the kids. So in 2019, we did that, and we now live in an amazing place in Vietnam and got a whole different lifestyle, and it's fantastic. The kids are still in an international school. But when I was leaving, even though I was in the finance industry, a lot of people said to us, how can you afford to do that? How can you afford to leave your full-time jobs, not have an income, and still kind of survive? And it really had a big impact. I was like, well, I just realized at that point we were in the minority of people who actually do save and invest. And that's coming from the people who I was talking to are in that industry. So they're kind of talking about it to their clients, etc., but very few are doing it for themselves. And some of them were earning a lot more money than I was, but yet they couldn't afford to do it. And that's because they just earned money but spent money. And it got me to think, well, whilst my kids are at school, what do I want to be doing? And I really wanted to have my kids have the same opportunity that we're now experiencing to be able to have this kind of time with our kids. So I've been talking to them about money, and then I felt like sharing those kind of stories, insights with other parents. And the great thing was that because I was talking about finance in language which would help parents teach their kids, the parents loved it because they were essentially learning about money in a really non-threatening, very, very basic, very, very visual kind of way. So using like that tree analogy that I kind of talked about earlier. So I kind of built up from there. And my kind of focus has kind of been, rather than going and talking to adults directly about them, it's more about talking to trying to focus on the next generation. So kind of prevention rather than the cure. To try and say, right, this current generations have never had much training, and there's a lot of really good stuff out there to try and say, such as Nova Money, trying to help encourage and change behaviors for that. But if I can help the next generation, but also the parents, then that's a double benefit from me. And there's not many resources out there that are helping parents teach their kids about money. There's a few really good charities which go directly into schools and talk to kids. But my kind of view is if you talk to kids, they learn about money and then they go home and the parents are doing the complete opposite, then it might be not as useful. Whereas hopefully if you talk to parents, and then they'll start to change their behaviors and try and be good role models for their kids.
Will, I want to come back to one of the things you said. So you were in a financial industry and you were selling basically investment to corporates who are supposed to act like in rational, educated way about their finances. And I guess although the income of you and your colleague were pretty comfortable compared to the national average, people had no savings and couldn't understand how you could leave your job.
Exactly.
And what's striking is the national salary in the UK is about 27, 30k, depending if you're London or if you're in the countryside. And it's quite hard to live in London on 30k when you look at the rent and the transport, like everything is so expensive. And so many people, they say, well, look, I can't save being on such income. And fair enough, it's tough. The problem is they believe if suddenly they would earn more, it would solve all their problems. And what I have seen my entire life is whenever people start to earn more, and eventually they will double their salary and they can even quadruple if they're like high performing in their career. But the problem is their expenses are always scaling at least as fast as their income.
Yeah, no, that's the classic. And also, people believe that they're going to get pay rises in the future, so they pre-spend them as well. And that's the other piece about it. But that's the hardest bit. And it's that whole people want status. They feel they get a title in their jobs and they want to live up to that title. So they kind of spend, they have the nicer cars, the nicer clothes, want to move into the nicer apartments. And which I don't want to say don't ever do that, but it's also trying to make sure that you don't spend it all. And that's the big message. It's not don't restrict yourself. It's restrict yourself a little bit so you can save some. So as your time, you do get promotion. Okay, fine. Spend 70% more than of that pay rise, but just keep that extra 30% for yourself. And over time, that will just keep compounding and compounding if you do it in percentages, and then you'll be in a much more secure position. And I think that's the hard bit, is, as you say, people just get that money and think about what they're going to spend it on, or in most cases they've already spent it and trying to just use that pay rise to recoup. And then once
because they were conditioned since their earliest age, if you have money, well, you need to think of how you're going to spend it.
Yeah, no, 100%. And that's why I think it's just so important that we all try and look at our behaviors, and especially when I'm talking to parents, is to say, make sure from a youngest age that every time your kid gets some money, get them to save just a little bit of it. And I think that's just such a powerful habit. If they do that every time, so they get pocket money every week, they're saving 10p out of every pound. They've still got 90p of every pound to spend and have that instant gratification buzz. But at the same time, they've got a little bit in there which is focused on delayed gratification. And if that's just what they do as they grow up, then they're going to be well ahead of about 90% of adults today.
Absolutely. I think it's a strong message that in life, you can enjoy, you can have fun, you can have your little pleasure, your luxury. But always remember to keep a portion of it to build your future, because it will accumulate and it will grow so fast. And that's what will make you confident and comfortable in life.
Yeah. I think that's the bit that everyone gets themselves worked up about, is kind of saving versus spending, instant gratification versus delayed gratification. They're not mutually exclusive. It's a case of, I say, 90% spending, 90% instant gratification, but just have some proportion that's there for delayed gratification, that's there for saving for the long term. And it doesn't have to be one or the other. It just needs to be both, because a world where you just save all your money is pretty boring. And I don't think I'd ever suggest people do that, but it's just a case of just don't spend it all.
So now let's talk about the benefit of the delayed gratification. Can you share with our audience, how did you feel? You had a successful career, you were making good money, and you had your safety net, you had your investment. How did that feel compared to your colleagues who were probably earning same, if not more than you, but had nothing for them?
So I think it's now, the hard bit is it's so, with anything like delayed gratification or patience, it's only after you've kind of got to a certain point. And so for me now, I have this freedom and that's the new gold. That's the new expensive watch or whatever it is. It's worth so much more to me than any of those material pieces. I get to spend all this time with my kids. I've got no kind of boss telling me where I need to be when I've got to be somewhere. And I can go to bed at night knowing that in the morning I'm going to have more money than I went to sleep with, because it's kind of growing and investing. And that just compared to my previous life. And again, I love my previous job. And if I have to go back in the future, I'd have no complaints about it. But the bit I'd miss is this kind of freedom. And that's why I'm enjoying life so much. And I think that's what I want my kids to have in the future, is to have options, to be able to see the world, travel, spend time with their friends and family, and sort of make the most of that kind of life. And that's the huge benefit. And I feel I try and now promote that but trying to stay as humble as possible, because you don't want to sort of upset people. But ultimately, I want more and more people to understand that freedom should be the ultimate goal, and being able to have that time with whilst you're young, because most people see freedom as when they're old, which is fine, and that's retirement. But to have even a short period, so I did a blog on mini retirements, because think about the generations today are going to work for, say, 40, 45 years, but then have to survive. Yeah, but then have to, because life expectancy is going up and up. That money's got to last them potentially up to 30 years, if not more. So you've got to work 40, 45 years, and that money's got to last. But when you are 65, 70, you're not as healthy, your family's kind of moved out, etc. And therefore, whilst you have freedom, then you don't have your full health. So having periods now where I'm kind of still relatively young, still have my health and ability to kind of do what I want with my family is huge, huge benefit. And I'm just so glad that I did what we did. We were still fortunate. We weren't one of these people so there's this whole FIRE movement of younger people living very frugally. And I think that's fantastic in terms of that mindset. We were fortunate that we didn't have to just eat beans on toast every day. That didn't seem like a desirable life.
Some people get quite extreme.
Yeah, they do. So I think it's just trying to get that balance. And for us, it's that freedom is the biggest reward from delayed gratification. But even on to your point about general patience, like just in case for the listeners, there's a great experiment that was done in the 70s. It's called the Stanford Marshmallow Experiment. And they got a group of young children and they put individually into a room and they said, right, you're going to stay in this room for 15 minutes and here's one marshmallow. And you can eat that marshmallow. But if you don't eat the marshmallow in that 15 minutes, we'll give you 2 marshmallows. So essentially rewarding them if they can delay their gratification. So they filmed them. And then what they did is they tracked those kids as they grew up. And there was a huge difference between those who ate the one marshmallow, i.e. ones who wanted that instant gratification, versus those who delayed and got the 2 marshmallows. Both not just in terms of their financials, because they managed to look after their money in more cases than not, but also in terms of, as you kind of mentioned, in other aspects of life, like relationships, how they progressed in their jobs, etc. Because patience isn't just about money, it's about not trying to say, right, if I don't get this promotion in 2 months, then I'm leaving. Or if this person if I don't know everything about this person, or they do something in a couple of weeks, I'm going to finish the relationship. And you have to be patient about dealing with people and situations has huge benefits. So, patience is the huge superpower.
It is. And actually, there are a lot of research. And what they do in this research, they measure the correlation between the ability to have delayed gratification and success in life. And by success, it's not just financially. It can be academic, financially, in a relationship, achieving what you want in life. Because as human beings, we need to learn things. What we want actually takes a lot of time.
Yeah.
And to get really what we want, then we need to kind of build in our mind the image of this is the end goal. This is what my dream life looks like.
Yeah.
And the delayed gratification is kind of building a stairway towards that goal.
Yes.
However, when we don't train that muscle, then we can't see that stairway, we can't build it, and we can't walk toward our goals.
Yeah. And I love that, the kind of way in which you kind of use that muscle, because I love the sort of mirror between health and wealth. And you kind of say to people about living healthily. And so they'll say, right, I'm going to go to the gym 5 times a week and I'm not going to drink any alcohol. I'm going to just eat salads. And then they'll do that and they might not
I hope more, otherwise you won't be very productive in the gym.
Yeah, exactly. But they don't see results straight away. And then it's so hard work. And then they don't see the results straight away, and then they kind of give up. And I think that's the same thing in terms of money. It's a case of you don't want to start saving loads of money and not spending any money, and then investing your money. And if you don't see any kind of results straight away, you're like, oh, I give up. It's too hard work. I'm missing out on all this stuff. But in both cases, the key is to say, right, well, say if you look at the health side of things, it's not to say give up all salads and do loads and loads of exercise. It's do a bit of exercise regularly and start to eat a little bit more healthy in your diet. And then over time, you'll see progress. And once you start to see that progress, you'll start to do a bit more and then you'll progress even more and more. And that's where you need patience to be able to say, right, I'm going to do something small and then wait a period of time and then I'll see the benefit. And it's relatively easy if you can get that patience to maintain that, because you're not saying you're not giving up all food. You're just giving up, I don't know, instead of having a whole chocolate bar, you're only going to eat a little bit of a chocolate bar or half chocolate bar or whatever it is. And the same thing with money. It's not a case of I'm going to stop spending altogether. It's I'm going to start saving a little bit. I'm going to start investing a little bit. And then once you start investing a little bit, and then you start to see some of the gains over maybe a few years, you then go, oh, right, this is good. I'm going to do a bit more. Okay. And then goes up and then do more and more. And then you have a financially healthy lifestyle, just as you would if you did a little bit of exercise every few days and started eating a little bit better than you did before.
Do you think that one of the problems of adopting delayed gratification is that it's hard for us to imagine how better off we would be in the future, whereas it's very easy to see what we're missing out or kind of missing out in the present, but what do we gain in the future?
Yeah, no, that is the hardest part of delayed gratification, is to say what benefit do I get in the future versus the benefit now. So I know that I can go and buy a watch today and I'll have a watch today. Whereas the opposite is to say, well, so say, for example, you had £100 and you say, right, I can buy a watch today for £100, or I can buy a watch in 10 years' time and still have £100 and have a watch. And then I'll be able to buy a new watch every 10 years forevermore and still have that £100 there. Now, one's like, well, so you can essentially have many, many watches in the future and still have your £100 if you delay, or I can have one watch now. And I think that's the hardest bit, because people can't imagine looking out into the future and waiting 10 years to get that benefit. But that's essentially what would happen, because if you invested your money, that £100, it essentially doubles every 10 years on average. So that in 10 years' time, you'd have 200, so you'd be able to keep the 100 and buy a watch. And 10 years later, again, you have 200 again, so you spend 100, keep 100. But you need to be able to see into the future and say, right, I'd rather have a watch every 10 years forevermore than just one watch today. And it's not until you actually kind of go through it and see that benefit that then you want to repeat it. So the first thing people need to do is kind of force themselves to be patient, even if it feels hard and you want to go and spend. Just have a practice at being patient and seeing some of those rewards. And once you do, then you're hooked. And I think that's what we generally see with people, is once they start to see the rewards of being patient, then it just sticks with them. And then hence why when I'm talking to parents, I sort of say to train your kids to be patient. I know some people are naturally more patient than others, but you can train to be patient. It's a case of, okay, I've got a chocolate bar, I'm not going to eat it all, I'm going to eat all of it except for 2 squares, and I'm going to put them back into the fridge. And then I won't eat it for a day or two. And then when you go back to the fridge, that day after or the day after, whichever one it is, you're just so happy that you did that, because the benefit of those 2 squares in 2 days' time is much greater than the sort of marginal benefit of just having an extra square when you're already eaten most of the chocolate bar. So when I'm
now you're talking about chocolate bar, it reminds me of my childhood.
yeah, exactly. Well,
So my parents have tried everything to make me like stop eating all the chocolate at once. They're trying to hide it in the cupboards and in places they thought I would never find. I always found the chocolate bar, always. And
what about if your parents gave you an extra bit of chocolate if you delayed? Because that's the other bit, is trying to get parents to sort of almost give them that reward for patience, and it's
they may have worked, but they tried another strategy. So at some point, I think they just got tired about me finding out and eating all the chocolate. They tried a very different approach. They said, we're going to buy 1 chocolate bar per week. Never more, never less. You want to have your chocolate every day? Look, it's here. We won't hide it.
Yeah.
And then I started to calculate. I calculated how many squares in a chocolate bar and how many per day I can eat so that I will have my daily intake. And I never overate chocolate for the rest of my life.
That's fantastic. I love that.
I was 7 years old.
You just learned budgeting, which is the key skill that most adults know.
Because I know the feeling of not having chocolate when I want to, and that's so much suffering. I didn't want to feel that ever again.
Yeah.
And it forced me to strategically allocate all my resources until the next refill.
Yeah. And that's the bit that doesn't even have to be for kids. The parents, adults today, and all the people listening can kind of do that to themselves. But again, they need to self-regulate and say, right, I'm only going to buy 1 chocolate bar, and I'm not going to just eat it and then buy myself another one, and kind of be quite strict and say, right, I'm not going to deny myself chocolate, but I'm only going to give myself 1 chocolate bar, and I'm going to have to budget it for however long.
It's harder as a parent because there's nobody else in the house watching and telling you off. What are you doing?
Yes, exactly. But I know parents who do it with TV time as well. They're like, right, you can watch, 3 hours of TV a week. So you can go nuts and watch 2 movies back to back, or you can kind of watch a bit of TV every day, but you're only getting 3 hours in a week. And again, kids learn to budget very quickly. They go for the instant gratification at the start, but soon learn that that's not the most optimal strategy.
If you had just one thing to teach about kids, what do you think would be the most important between the financial education and learning delayed gratification?
No, so I would say if kids can grow up learning to save a little bit of money for later as a habit, even if they didn't learn anything else about money, I think they'll be better than sort of 70 to 90% of the population, because essentially the first rule of wealth is don't spend less than you earn, and that's all about behaviors. That's not about knowledge. The analogy is that doctors know more about health than anyone else, but yet we still see overweight doctors. So they have all the knowledge, but if they haven't got the behaviors, then it kind of overpowers their knowledge.
And smoking and drinking, all the impact on the cancer rate, etc.
Yeah, so if people want to become financially healthy, they need to understand their behaviors and say, right, how do I stop myself from spending all of the money that I earn, and how do I save just a little bit, and then hopefully over time learn how to make that money grow.
How did that work for you? How was the kid will? How did you do with the sweets and chocolate?
When I was a kid, I never saved for the long term, but my parents are good. I can't remember having many detailed conversations with them about money. But the 2 things about my parents was they never gave me money for toys or anything like that outside of Christmas and my birthday. So if I ever wanted anything, I'd have to use my pocket money. So therefore, I was really into computer games, so I'd always have to save up a few weeks of pocket money to get the game that I wanted. So that really taught me about making sure I do save a few weeks rather than going to the shops, or otherwise I'd never be able to have any computer games or have to wait for quite a while for my birthday. But also the other bit about my parents was that they retired pretty much as soon as I left university. So they stayed in the same house for 25 years. And they had the opportunity to upgrade to a bigger house as they got promotions, etc. But they didn't. They stayed in the same house. So as soon as I finished university at 21, my parents packed up and said, right, we're off to Spain to live in the sun. And then so I would be working in my graduate job, working really hard, doing long hours. And I'd phone up my parents and they'll be just telling me about this wonderful life and having all this freedom. And I was like, right, that's what I want. So that had a big impact on when I first started earning kind of good money through after university, to say, right, I don't want to go into debt because that puts me further away from achieving that goal. So I was really fortunate that from a young age, I had not an explicit goal to do what we're doing now, but always to have in my mind that
was your role model. That was your vision of financial freedom.
And it just showed me that money can lead to freedom, which is never taught. It's never implied. It's always just assumed that freedom comes at 65 and you don't need to think about it because that's just what everyone does. Whereas actually, I'm so glad that I kind of got to see that role model and say, right, how do I go about sort of achieving that myself? So when I was in my young 20s, I started to save up for an apartment. So I got my first apartment, so it wasn't in London, it was just south of London, because I was working kind of near London, so I'm commuting into London quite regularly. So I bought my first apartment when I was 25 years old and sort of then tried to pay off as much as possible, as quickly as possible.
I'm sure people who are 25 years old nowadays listening to this podcast will be very depressed.
Yeah,
if you look at the price of flats and you're 25.
Yeah, but the good bit is I cared more about getting on the ladder, and so it wasn't in the most glamorous of places. It wasn't in London. I cared more about getting on the property ladder and having my own place and not renting than trying to be in the hub of everything. I didn't mind commuting, driving to places rather than just having to get on the best train line.
Will, you said something very important. People since our earliest age are all like almost brainwashed that they need to consume, they need to buy stuff to be more and to be happy in life. Whereas your inspiration and your role model was the financial freedom that your parents were aspiring to.
Yeah.
How did you think that shaped and influenced all your aspirations?
Yeah, so I think it just made me. So I liked nice things. So I remember
we all do.
Yeah, we do. But because when I was younger, when I was a young kid, I remember drawing pictures of big mansions and thinking about nice cars, and used to watch program MTV Cribs, which kind of goes around all the fancy sort of superstars' houses, etc., and saying that's what I kind of want. But then once I kind of started working and sort of saw the trade-off from having those things, all of those things.
What was the trade-off?
So instead of having money in the bank, I would have to spend my money. And that was the biggest one. I didn't want my bank account to be zero, because I knew that if I wanted to have kind of what my parents had, I needed my bank balance to be more than zero. And it needed to grow over time. So if I spent all my money on these nice things, then I was kind of going away from that. And that was had a big impact on me. So I still spent, but I always made sure that my bank balance was going up and up, or as I had a mortgage, less negative over time. So I actually owned some assets and started investing when I was in my sort of late 20s as well, to again try and find ways to have income. And again, that's saying based on having that clear goal that in the future I do want to retire early, that I need to have money coming in. And so I can't just own my house, because that didn't bring an income. So that's why I started investing in the stock market, so that money can grow and produce a bit of income every month, which will supplement. And that's just carried on growing and growing over time. And
okay, so you started to save in your early 20s when you started your career. You got your first house at 25, right?
Yep.
Okay. So the house is typically the biggest asset you will own in your life.
Yep.
So you started to build your assets really at 25. And then how did you make the shift from continuing to save versus investing to build even more diversified assets?
Yeah, so it's a bit so I'm fortunate I've had the sort of background in investment and finance. So at that point, interest rates were starting to come down. So my mortgage payments were much lower. So then I had the kind of conversation with myself to say, well, do I overpay my mortgage, or can I get better outcomes if I invest some money? So that's why I decided that I'm going to continue paying off my mortgage, but I'm not going to just overpay as much, and I'm going to start putting some of that money into investments, because I think I can get a higher return than the interest on my mortgage. And that
Can you walk us through the math and all the decision-making process that you had?
Yeah, sure. So my interest rates kind of went down from, so when I first got my mortgage, it was nearly 4%, and then it went down to about 1% broadly. So then I had to say, right, if I'm going to pay, so if I say I've got £1,000 that I could save or pay towards my mortgage, extra towards my mortgage, or then I had to say, well, do I want to pay off that mortgage, which is going to essentially give me a 1% return, because that's the interest rate that I'm paying on that mortgage? Or can I take that £1,000 and get a higher return somewhere else? And that's where I decided, actually, I think I can get a much higher return if I invest it in the stock market. Not every year, because the stock market could fall, but this money is not there to be spent in the near term. It's for the long term. So I said, right, no, for that amount, I'm going to start putting money into the stock market rather than overpaying on my mortgage. My mortgage it was already capital repayment, so it's going to go down slowly already. But I decided, instead of accelerating that, I'm going to try and accelerate my sort of asset money growing by investing.
Okay, so was it a purely logical decision? You looked at the cost of the interest rate, how much you would save if you repaid early. You looked at the opportunity of investing and how much you would make on a compounded return, and then you picked the number that made the most sense.
Yes, largely, yes. And plus I was just kind of interested in the stock market and wanted to be investing in the stock market and also getting an income as well from that.
Okay, so it's as simple as that.
Yeah, no, exactly. I think if over the long term, I believe that, my money in the stock market is going to grow faster than the amount of money in my mortgage. But don't get me wrong, I still want to get rid of my mortgage, and we're still getting rid of that because there is that chance that interest rates go much higher in the future. And I want to make sure I'm not got too much of a mortgage if that scenario happens. But at the same time, so it's trying to get that balance between the two.
And actually, a lot of people believe that investing and managing your finance is super complicated because, you have been in industry. And the industry is very good at using jargon and making everything much more complicated than what it really is. But actually, isn't it just damn simple?
Yeah, no, it's can be very simple, and especially investing in the stock market. I've used in posts and blogs that I believe that the stock market is like a sheep in wolf's clothing. So on the outside, it looks scary, and because of the jargon, because of the scary news headlines that they try and put out there. But actually, investing can be very, very simple. Essentially, just put your money into a fund which invests in thousands of companies, and you just put some money in every month, just like you would put money into a savings account. And then over time, just let that grow. And the key bit, again, is you have to be patient, because in the short term, it can go down. But if you're patient enough and just ignore that and say, right, this money's there for the long term, then everyone who has done that has benefited over the long term, much more so than putting their money into a savings account. But some people put their money in investments, it goes down because the stock market does, and then they sell when the market's down and lose that money and say investing's too risky and you can lose all your money. But actually, if you keep your money in there for the long term, very few people have ever lost money over the long term.
And I think the key is to have already enough saving as a safety net to make sure that you have enough whatever happens to survive the next 3, 6 months, 12 months, whatever makes you feel comfortable and safe.
Yep.
And then everything else is just investing.
Yes.
And don't forget it might crash tomorrow, it will go back the day after, its volatility. But what matters is in the long run, there's a trend, and the trend is mostly up.
Yes. Oh, yeah. No, it's you show a chart. I was showing a chart to someone of the history of the stock market, and it does this huge sort of upwards curve. And if you look even back, say 30 years, you can't even see any of the bumps. So at the time, say 30, 40 years ago, some of those sort of stock market crashes probably frightened everyone who was investing at the time. But if you look back at it today and look at the charts, you can't even tell it's a little bump. And yeah, and those people who have benefited from that big upward curves are the ones who have just been patient and put some money away and not needed that money straight away and kind of benefited. So again, Warren Buffett, who's one of the richest people in the world, is one of the richest because he's been investing for sort of 80 years and it's just gone up and up and up. Not to say everyone has to wait 80 years to get that benefit, but he's at the very extreme. But compound interest, which is the earning interest on interest, just takes a little time to get started, but once it does, you really get the benefits. And again,
Warren Buffett is the first one to say that investing is actually simple. So a journalist once asked him, but if it's so simple to invest, why people are not doing it? And his answer was, because nobody wants to get rich slowly.
Exactly. And that's what I want to teach my kids, and that's why I've started talking to them from an early age, because we started investing for them pretty much when they're very young. So they've got so many years advantage over most people, and pretty much everyone who has started investing, pretty much across the board, everyone says, I wish I'd have started earlier. And that's why it's so important just to start. It doesn't matter if it's a small amount, just start.
Well, what would be your recommendation for all those who are kind of hesitant, they don't really know if it's for them? What's the easiest way? Would you recommend ETF, something else?
Yeah, no, ETF, index fund, so using the likes of Vanguard or Fidelity, or go for the kind of robo ones like Nutmeg in the UK. These very simple platforms where you can essentially just hand over some money on a monthly basis, and it doesn't have to be a large amount, and they'll start investing on your behalf, and you have access to hundreds and up to thousands of companies. But a key piece about investing is don't try and pick stocks. And I think don't try and pick which companies are going to do best or worse. All you want to do is get invested in the stock market as a collective. People who try and say, all right, when's the stock market going to go up or down? Or is that company going to do better than that company? You'll hear lots of people give opinions, but over the long term, Nobody knows. It's going to average itself out. You'll get some winners and losers, so best to just have the average and keep it simple, keep it cheap.
I'm becoming more and more convinced that the number one reason people don't invest is they believe they need to do stock picking, and that investing is about stock picking.
Yeah. No.
And it's so hard because when I try to convince people that they should not do stock picking, they should not try to outsmart the rest of the world, because 99% of people who do it as a profession and are paid a lot of money to do it, they can't do it. They underperform. They still don't believe me. Even if I tell them, look, I've been in the market, I've been in the trading floor, I've been talking to the people who are doing that. They invest their retirement money on ETF, automated fund. They don't do any stock picking, but people still believe they need to do stock picking, and that's what it means to be smart with money, to do stock picking. But it's all the opposite.
It's so hard. And my career, I was advising these large institutions about that, and as part of that, I had to talk to these asset managers, so I got to talk to some of the sort of smartest people in the investment world. And not to say anything bad, I think there's some people who can do it, but my view is for 99% of people, they can't, and therefore, I know for myself, I invest in sort of index funds, so just copy the whole market. And that's me saying that after 17 years of sort of doing lots of work in investments, I still go for the simplest strategy, because it just makes my life a lot easier, and it does better than, I say, 90% of other strategies, which are a lot more expensive and a lot more complicated.
Absolutely. So if there is one takeaway, don't try to over-engineer investment. It's actually pretty simple. Invest in ETF and you'll be better off than 99%, not of people, 99% of people who invest. So 99% of the 90%.
Yeah. That's crazy. Yeah. But you might not do that every year, and that's the whole point. Every year you're going to do average. So next year 50% will do better, and 50% will do worse. But over a long period of time, as you say, it'll be sort of 99% better, because the ones who did well in the first year are going to probably do bad in the second and third, and so on and so forth.
Excellent. Will, do you have any book recommendation to close this podcast?
So I do. So the book that I love, and I think everyone should definitely read, is called The Richest Man in Babylon. It's just it's really short. It's written in stories, and it just goes through the very basics of how people should look after their money. And everyone who follows the kind of rules set out in that book, I'm pretty much guarantee that they will end up wealthier than 90% of people. The hard thing is most people won't follow those rules. But if they do, then they will be much more financially healthy and wealthy in the future.
It's a great book. It's the second time it has been recommended in this podcast, The Richest Man in Babylon.
There you go.
And if people want to know more about you and your services, how can they find you?
Yep. So my website is www.bluetreesavings.com. So I have a weekly blog which helps cover a different money topic in such a form that it helps parents teach their kids about money. So whilst it's aimed at ultimately helping children, a lot of parents are finding it. And now I've got a lot of people subscribing who don't even have children themselves, just because they find it just an easy way to digest lessons that they haven't been taught themselves.
Maybe we should remind that financial education is the best investment of all the investment you can make in life.
Yep. And I also, my name's Will Rainey. So I'm on LinkedIn, and I generally post quite frequently of a short little tip about personal finance.
Will makes awesome posts on LinkedIn, really teaching and visualizing the impact of the delayed gratification.
Yeah, perfect.
Awesome. Thanks. Will, thank you so much.
Thank you, Sam.
All the best for your financial freedom.
Thank you. Bye-bye.
Thank you for listening. I hope you found this episode enjoyable, inspiring, and educational. In this era of instant gratification, it is more important than ever to train our delayed gratification muscle. So keep learning, keep improving by 1% every day. You may not see the results right now, but this is a secret of all the successful people I've met. Please help me spread financial education by sharing this podcast with your friends and community. I would love it if you could also leave us a review. It really helps the show. Now, I would like you to forget about all the advertising that is being pushed to us on a daily basis and think about your personal financial goals. What do you really want to achieve with your money? If you have financial objectives, then check out the Nova Money app. Nova is an AI that will show you how to set financial goals and how to achieve them. A plan is only useful if you can follow it. That's why Nova will send you daily motivational messages to give you the strength to ignore the daily temptations of spending money and stay focused on your goals. Like other budgeting apps, Nova connects all your bank accounts in one place to give you the full picture. The difference is that the Nova AI will do all the budgeting and tracking for you. The second difference is that unlike many free personal finance apps, we don't sell users' data. All your data is encrypted and will remain completely private. Make sure that you're investing in your financial education. Make sure that you're building your financial freedom. And I'll speak to you in the next episode.